Good morning, everyone. This is Monday morning, about 11 o'clock here in Angleton, Texas. Hope things are going well for you guys. Just wanted to give you some updates on where we are and where we think the market is, and a few changes that are probably about to happen to portfolios. So I want to just start by talking about how did we get into the situation we are right now with our economy. We have done some unprecedented things, and that's why as much data as people have been generating on what this looks like and where we should go from here, the simple fact is we're in uncharted waters simply because we shut down, the federal government shut down our economy completely and then dumped about $7 trillion worth of assets. A good portion of those were paying people to stay home through the pandemic and so forth. So now all of a sudden we're opening the economy back up, and we have supply chain problems because people are wanting to buy automobiles and appliances and take trips, and they have the money, but they don't have the ability to have those things being built. There were no plants building automobiles during that period of time. People were not cutting trees down. You were not seeing pulp mill factories working. And so all of a sudden we're in a place where inflation is now at a 40-year high. The feeling by a lot of people that I listen to is we are fairly close to the peak of that, but it doesn't necessarily mean that inflation is going to go away. It may actually resolve itself in the 4 to 5% range, which is 2 to 3 times what it was for the last 20 to 30 years. So there's a number of things that we try to do with portfolios, and I'm going to go through that in some detail in just a moment and talk about that. If inflation remains, we will end up moving much more to hard assets, and that is real estate in particular, perhaps gold and silver and other kinds of things. I want to talk with you a little bit about some things that, if I can get my screen up here, I want to talk about something with you for just a moment. Need to go to shares. 50% drop and took several years to come back. You take a look at what you see a little bit further downstream here. This was COVID. This was basically March of 2020, and it seemed pretty phenomenal at the time because it was a 30% drop in the stock market that fundamentally took 3 to 4 months to come back. What you're seeing at the top of your screen, I want to go into details in just a moment, is where we currently are. But let me just say a couple of things. It has been common since the beginning of the markets that we have right now. The S&P 500 has been around about 40 years. That's the 500 largest companies. It's been common to have a 10 to 15% sell-off once a year. Now, many of you are new into investing in the stock market, certainly new investing with us. And each time that happens to somebody that's new, it's the end of the world. And we feel like we might as well climb up on the roof and jump off because it's the end of time. The fact of the matter is those are critical things in our world. They're very important and we have to have them. This literally is when the big institutional guys decide, because of inflation, we want to get out of stocks that don't pay a dividend like technology, and we want to get into stocks that pay big dividends like the banking industry, I would say the oil and gas industry, the pharmaceutical firms. And so this is just rotating from one sector to another. A couple of other things I want to show you going forward. This literally is just a drawdown, the ups and downs on stock markets going all the way back to 1980. And you can see the good and bad years and so forth. This is kind of where we are right now in 2022. We're down about 13%. But take a look at the years prior to that. In 2021, the stock market made the S&P went up 27%. This is unmanaged. This is simply taking the 500 largest companies. You want to know what's happening right now, take a look at the 3 years prior to this, where in 2019, we were up 29%. Then we were up 16%. And that was a 30% sell-off in March of 2020 from COVID. It took about 3 to 4 months to come back, but we from January 1 to December 31, we're up 16%. 2021, you can see the number 27%. This is what caused the big institutional guys, the people that we use to manage your money. They look at this and say, stocks are too expensive. So we're going to back away from the table for a little while. And oh, by the way, we'll probably put out all kind of news that scare people to death, and we'll have people sell. And when we get ready, we'll come back in. And this is what you see happen. And this literally has come from 3 years of appreciation that's a little bit, that's not sustainable according to most of the experts. Now, I want to show you one other thing for just a moment here. This is the S&P 500 for the last 3 months. I want to show you something here that's very important for you to understand. I want you to take a look at the line where my cursor is. You can see the 8th of March, we bottomed out at 41.73. A week later, on 3/14, we bottomed out at 41.73. 2 months later, in the latter part of April, we bottomed out at 41.73. In early May, we had a little bit of a sell-off right in here that would be slightly below that for a short period of time. These are days, and so this is individual days. We have a pop above this, which happened yesterday. Here's the sell-off we're seeing today. What I want you to look at is what in the world could possibly happen so that the markets bottom at exactly the same place? Well, that would be computer trading. That's when the institutional guys say, this is where we want the markets to get to before we get involved, before we step back in and start buying. The big institutional guys that manage multi-trillions of dollars would be Fidelity, which manages about 25 to 30% of your assets. The same thing would be true with Vanguard. The same is true with American funds, with many other funds, BlackRock and Blackstone. All of them are multi-trillion-dollar firms. So we largely follow their lead. Having conference calls with these guys on a regular basis and talking with them about what they're buying and selling, I know where they are, and we really take our view of what we're going to do from them. I want to take this a step further, and I want to show you this number here that I just showed you. This is 12 months. And if you would look all the way to the far left-hand side of your screen, what you're going to see is we are exactly where we were 1 year ago. Not sort of, kind of, we're exactly where we were 1 year ago. So what we have done basically is erase about 15% of returns from, as you can see right here, this is from the May time period. This is 1 year ago today. So you take a look at the May time period here up to where we topped, and we were at almost 4,800, which was up about 15%. We have given that back. And so this is where we are now. And I'm going to tell you, we are watching carefully and in conversation with people about, does this hold? If the selling is greater than the buying, and this drops a little bit beyond this, we will begin making changes in our portfolios. And I want to talk about that in just a second. So we are watching on a daily basis this number that if I can get my cursor on it here, basically, where are we? Are we holding at this place? If we do not hold at this place, then what we will be doing is moving into what I would call hard assets, specifically real estate, gold and silver, and other things. And I want you to think about this for a moment. Many of you have heard, even from me from time to time, that stocks and bonds move opposite one another 70 to 75% of the time. Well, that means that 25 to 30% of the time, they do not move opposite one another. They move the same. One of those significant times is high inflation. So what's happening now in your portfolios, and I would say our conservative portfolios right now are down 7%. off their highs. We're down in most portfolios 10 or 11. For you to, if you were to pull back the curtain, what you're going to see is a good portion of your losses are not from the stock market, but rather from your bonds. In an inflationary period of time, what happens is if I own a bond that's paying me 4%, and you can go buy a new bond that's paying you 5%, then my bond's not worth $1 on the dollar. It's only worth 80 or 90%. That's what's happening in inflationary periods of time. If this holds, then our portfolios will remain intact. If we drop below this, we will be basically, and we are to some extent anyway, replacing bonds with real estate. What's the difference? Well, the similarity is they both will pay a 5%, maybe a 6% dividend on a monthly basis. The difference is hard assets like real estate will appreciate in inflationary times and bonds will not. So fundamentally, what we're looking at is watching to see if this number holds. We have had, as you can see here, fundamentally a test here on March the 8th, another test here on March 14th, the next test here on April 26th, the next test on the 29th, and this is where we are today on 5/2. So this to me is an impingement point that we will take a look at and determine whether we start moving money around or not. If inflation is going to be above 4% for 2 to 3 years, that's a tough place to make money in bonds. So when we look at things that are non-correlated, we want things that do not move up and down together. We will begin replacing bonds with real estate. I want the ability to have capital appreciation from the real estate and plus give us the stability of about a 4 to 5% dividend, maybe as much as a 6% dividend. So that's fundamentally where we're at on our portfolios. And as I have a chance to meet with many of you guys in the next several months, as we will be on the road, we'll talk about this in some more detail. The one thing that we do if the market stays down for a little while, those of you that are in systematic withdrawals, if we're taking 5% or more, what we will do is we will go to cash and start paying your monthly money out of cash, so we're not eating into our growth type investments in this period of time. We really feel like that we will be in a very different place in 60 days than we are right now. And that really is probably where the Federal Reserve will have made all of the rate increases that they're planning on making. So we made 50 basis points yesterday. 2 months from now, the next meeting, we're expecting 50 basis points again. 2 months after that, possibly another 25 to 50 basis points. But we feel like that's largely baked into the cake. And so that's kind of where we are on all of that. Taking a look at just understanding what's taking place here, I want to just make a point. This comes out of conversations I have regularly. If I can help you learn what volatility is and learn that it's natural and learn that it's literally like inhaling and exhaling, and having 10 to 12, 13% sell-offs annually is not the end of the world. Hopefully you will be like many of my clients and me, where I've seen it 100 times. It just looks like another day. And that's what I want you to get used to. There are people that really their hearts can't stand this. What happens is we go back to much more guaranteed type investments where you'll make a 4 to 6% return as opposed to an 8 to 10% return. In a situation where I'm helping 4 and 5 generations of people manage assets for their children, grandchildren, great-grandchildren, the difference in a 4% return and an 8% return is astronomical. I want you to think about the rule of 72. Whatever your return is, divided into 72, and that's how many years it takes to double your money. So do a little bit of math between 8%, which is what we target in our portfolios, and something that would largely be guaranteed at 4%. And you see why it would be to your advantage, and certainly to ours, for you just to learn about volatility, to kind of pull the curtains back and see what's going on. And I would tell you, I have a presentation here. I only showed a couple of slides, but there are many more presentations involved, many more slides. If you have an interest in this, we can certainly email you or hard mail you copies of it, and would love to do that if you want to look at this presentation in more detail. This is a company called First Trust that we use a lot of their products, and we get things like this on a weekly basis, and I would be happy to go over that with you. So that really has covered everything that I want to talk about today. I hope this is a beneficial time that you've spent looking at this. I'm hearing at least a couple of times recently, you're sharing this with friends of yours, and they are now becoming clients. And so we're going to get a little more detail, just like I did today, and taking a look at this presentation on a monthly basis and just let you know what we're thinking and where we are. We will bring it down eventually to our own allocations and what we're doing and what we're looking for and what we would consider a trigger point that would cause us to see things differently than we do right now. What we learned over the years is we handle basically about a half a dozen different portfolios. So we may have 200 families in the same portfolio or some combination of two portfolios. I don't look at people's individual accounts every single day. We have about 840 households. I personally take care of about 300 of those. I do, however, know exactly to 0.1% what each one of our portfolios does every day. That's what allows us to know exactly what's going on in people's portfolios. We're not doing one-off type things because it's not to your advantage or ours. So with that, I will say goodbye to you. If you have any conversation you want to have or questions, be sure and let us know. And hope you're safe and look forward to seeing many of you soon. Take care.